All right, let's jump straight in. We are doing a rigorous breakdown of the Reserve of KING-KAMBUF Financial News and Reports magazine, weekly market digest and investment analysis. Specifically, we're tearing apart the daily report for Monday, November 24, 2025. And you really need to be paying attention this week. You're walking into one of the most intense short weeks of the entire year.
Absolutely. The liquidity just dries up completely ahead of the Thanksgiving holiday.
Which means markets can get really choppy. Sudden, sharp moves are not just possible, they're probable.
Right.
So knowing precisely where the institutional money moved on Monday and what the key indicators are telling us for the next, say, 72 hours is not just helpful, it's absolutely critical.
It's your roadmap.
Exactly.
Right.
Our mission here is to perform a comprehensive, granular analysis of this KING-KAMBUF daily report. We're not just reading the numbers back to you.
Now we're extracting the actionable intelligence.
The subtle shifts in market breadth, the specific trade setups, the portfolio ideas. This is your shortcut to being completely informed, to filtering out all that emotional noise and just focusing on what the market actually did.
And we really have to start by setting the macro stage. Monday wasn't just about earnings or individual stocks.
Not at all.
It was driven by high-level policy and, well, geopolitics.
Mm-hmm.
While that short week introduces all that potential for volatility you mentioned, the underlying sentiment just took a dramatic swing towards the positive.
And the market loved it.
It embraced it immediately. The report highlights two gigantic catalysts that fueled this powerful rally. First, and I think this is the most important one, is this massive injection of optimism around a potential Federal Reserve pivot.
A rate cut.
Rate cuts. We're seeing sustained momentum behind the idea that the Fed may actually cut interest rates in December. And look, the market isn't just hoping for a small tweak.
No.
It's pricing in a significant 25 to 50 basis point cut. That kind of policy shift is just a colossal psychological boost for risk assets.
And the second catalyst, it's a fascinating contrast, really. It came from the geopolitical realm.
Yeah, the Trumpies call.
Exactly. The positive sentiment after President Trump announced a very good telephone call with President Xi and not just talk concrete plans for a face-to-face meeting in April.
And that might seem like a small thing, but right now it's magnified exponentially.
Why is that?
Well, when the VIX, the volatility index, is already elevated, any sign of stability, especially between the world's two largest economies, is immediately taken as a green light for taking on more risk.
So less anxiety.
Less geopolitical anxiety means less uncertainty for all those multinational tech and manufacturing supply chains. That translates directly and immediately into capital inflows.
So let's just give the punchline right up front before we dig into the weeds. This wasn't just a moderate bounce back.
Not even close.
The market had a truly robust rally on Monday, November 24th, driven almost entirely by growth stocks.
And specifically, the tech-heavy Nasdaq Q composite.
It didn't just have a good day. The KING-KAMBUF report says it posted its best single-day performance since May of 2025.
Think about that. The best day in over 6 months. That tells you the institutional mood has shifted dramatically in just 24 hours.
Okay, so let's quantify that recovery. Let's get into the hard numbers from Monday, because the major indices really did roar back to life.
They did. It signaled that the dip from last week was, basically bought up a very high conviction.
The S&P 500, our essential benchmark, surged. It finished up between 1.5% and 1.6%.
Closing at 6,705.21.
For the S&P to move that aggressively on a Monday, that shows some serious momentum right out of the gate.
And that number, 6,705, it's pretty significant. It puts the S&P 500 within striking distance, just 2.8% of its all-time record set last month.
And that's after a bit of a scare, right? The prior week saw that 2% decline.
Right, which created some worry. This powerful move on Monday really confirms the KING-KAMBUF analysis that that previous drop was likely just, technical cooling.
Or profit-taking.
Exactly. Transient profit-taking, not some fundamental change in the overall uptrend. The market's underlying health, it seems, remains pretty robust.
But the undisputed star of the show was the Nasdaq Q composite.
Oh, absolutely. It led the charge.
It climbed a monumental 2.7%, closing at 22,872.01. That kind of gain is a massive statement. And as we said, the report confirms this was its best day since May 2025. So what does that mean? What was happening in May that we're seeing again now?
That's where the real insight is. May 2025 was, the height of that early-stage AI infrastructure hype cycle.
After all those strong chip reports.
Right, from the major chip and cloud providers. Now, here in late November, we are seeing that level of enthusiasm come roaring back, but for a slightly different reason.
Cheaper money.
The anticipation of cheaper money. You see, the tech sector is probably the most sensitive to interest rates, and when the prospect of rate cuts appears, growth stocks just get instantly re-rated upwards.
Which explains why the Nasdaq Q snapped back so much harder than everything else.
Precise.
We can see that disparity so clearly in the Dow Jones Industrial Average. While the S&P and Nasdaq Q were just soaring, the Dow showed much more moderate gains.
Very moderate, only up between 0.4% and 0.6%, closing at 46,048.27.
So why should you, the listener, care about that difference?
Because it's vital to understand what kind of rally this actually is. The Dow is a blue chip index.
Right. Industrials, defensive stock.
Exactly. Established value companies.
Yeah.
Those stocks don't just jump 2% because the Fed might cut rates. Their businesses are less reliant on massive future projections and more on, well, current economic stability.
So the fact that the Nasdaq Q climbed 5 times faster than the Dow tells you?
It tells you this was a growth conviction rally. Money wasn't fleeing from fear. It was actively chasing future potential.
That's a great point. And what about the smaller companies, the Russell 2000?
Also up 1.9%, which is a good sign. It indicates that this risk appetite wasn't only limited to the trillion-dollar mega caps, which is a healthy sign for market breadth.
Let's follow the rate cut fuel you mentioned, because it really does feel like the engine driving this whole thing. Can we simplify for everyone why rate cuts help growth stocks so dramatically?
Absolutely. The easiest way to think of it is through the lens of valuation. A growth company, let's say a software as a service provider, generates most of its expected profits way out in the future.
5, 7, 10 years down the road?
Exactly. So to value that company today, analysts use what's called a discount rate. It's basically the cost of capital, to bring all those future profits back to what they're worth in today's dollars.
Okay.
So when the Federal Reserve signals that rates are coming down, the cost of capital drops. That discount rate falls. And suddenly, that projected dollar of profit 10 years from now is worth significantly more today.
So it just inflates the models.
It instantly inflates the valuation models of all those high-growth, high-duration tech names. That's why the pre-market futures surged on Monday morning. The market was instantly pricing in cheaper capital and less restrictive financial conditions.
Which caused that aggressive snapback we saw.
Exactly.
Okay, now let's turn to the market's emotional state. The VIX. We always call it the fear gauge.
Right. It tracks the market's expectation of near-term volatility.
And the KIMBUF report focused on a really crucial technical move here. The VIX declined sharply by 6.05%.
It dropped 1.08 points to settle at 16.77.
So that sounds like a very technical number, but what does 16.77 actually mean for the average person trying to figure this out?
It means the premium for protection has basically evaporated, at least for now. A VIX reading up above 22, maybe 24, tells you that institutional options traders are actively buying downside protection.
They're scared.
They are terrified of a sudden sharp drop, but when it drops below 20, that level of fear really subsides.
And 16.77 is well below 20.
Very. The move to 16.77 is highly significant because it signals a transition from genuine caution to, relative complacency. The market has processed the geopolitical news, the Fed pivot hopes, and has concluded that the risks are manageable in the short term.
It's a key indicator of broadening risk appetite.
It is. The report stresses we have to watch the 1819 level now. If the VIX pushes back above that, the calm is probably over, and we should expect more chop. But for Monday, the message was loud and clear. Fear is off the table.
All right, moving beyond the broad indices, let's dig into the specific companies that acted as gravity, the ones pulling the market higher, and also those that were facing their own individual crises.
Right, setting the stage for the rest of this short, crucial week.
On the bull side, it was all about the tech megacaps. They were driving the bus. Alphabet, GOGL, surged between 2% and 3%.
And that was driven by speculation around its latest AI model advancements.
So this wasn't just a technical bounce for them. It was a fundamental conviction trade that basically reignited the entire AI thesis.
It really did. It was confirmation for institutions that innovation cycle has a lot more runway.
We also saw some strong, very strategically timed moves. Amazon, AMZN.
Got their high-profile upgrade from Goldman Sachs.
And the timing on that is interesting, right before the holiday shopping season.
Of course. The rationale wasn't just about the stock price. It was squarely focused on its positioning for the critical holiday season, starting with Black Friday. Analysts are confident in Amazon's ability to capture dominant retail volume, leverage its logistics, and defend its margins.
So it's a key discretionary play going into the new year.
It is.
Yeah.
And then, of course, you have the semiconductor darling NVIDIA, NVDA.
Yeah.
Analysts at Bernstein reiterated a buy rating, and they cited still early data center upside.
That's a crucial point. Even after this historic run, the thesis is that the global AI infrastructure build-out is only in its infancy.
Exactly. And that conviction explains why NVDA was the most active stock of the day by volume. Institutions are not just holding on, they are actively accumulating on any dips.
Okay, but if the whole market was basking in this hope and a lower VIX, why are we still seeing this deep structural weakness in some major names?
Right.
Novo Nordisk, NVO provided a really sharp, painful contrast to all that optimism.
A huge contrast.
This stock, a pharmaceutical giant, sank about 9% pre-market, and it closed down 5.58%.
And the cause was so specific. Disappointing results from their high-stakes Alzheimer's drug trial. This isn't a macro story at all.
No.
This is the concrete reality of execution risk, even for the biggest names in the world.
That Novo Nordisk case is just a perfect narrative contrast.
It really is. It shows that even with geopolitical peace and Fed pivot hopes, idiosyncratic risk never, ever disappears. Billions of dollars in market cap can be wiped out in an instant if a clinical trial fails.
And that loss had to weigh on the overall healthcare sector.
It did, and it served as a stark reminder to portfolio managers that diversity, even within a single sector, is absolutely essential when you're dealing with high-stakes biotech and drug development.
So when the KMBUF report digs into the 52-week extremes, these specific stories become even clearer.
Crystal clear. On the high side, you saw Eli Lilly, LLY, a rival pharma name, hitting an astonishing $1,063.55.
Which just confirms the huge valuation placed on successful drug pipelines.
Exactly. We also saw deep industrial strength with Carpenter Technology, CRS, up over 82% year-to-date, and then just the sheer scale of the tech giants. With Alphabet GOG hitting an all-time high, its market cap is now soaring past $3.24 trillion.
It's incredible, but conversely, the 52-week low list shows us where the fundamental doubts are concentrated.
Where investors need to be extremely cautious.
Novo Nordisk, obviously, trading near its 52-week low of $43.08. But we also see Neo Inc., NIO, still volatile near its previous low of $4.37.
And that just highlights the ongoing brutal competition and stress in the broader electric vehicle sector.
Especially for companies that are so exposed to those cutthroat international markets.
Where the price wars are still absolutely raging, these are areas where momentum trading is incredibly risky and the fundamentals point to sustained operational headwinds.
Okay, so looking forward, the earnings calendar basically defines the rest of this short week. It's the next big volatility catalyst.
It is. Monday's reports, Agilent, Keysight, Zoom, they were a good appetizer. Keysight was already up pre-market, which suggested a strong read on IT hardware spending.
But Tuesday, November 25th, that's the market's real test. This is where we get the critical reads on the consumer, on enterprise IT, and global commerce.
Huge day.
Best Buy, BBY, is under immense scrutiny. The market isn't necessarily expecting a massive blowout, right?
No, it's more about stability going into the crucial holiday quarter. Their EPS forecast is $1.31.
So a slight beat, maybe some strong guidance, could lift sentiment for the whole consumer electronics retail space.
Which has been under a lot of pressure. Then you have the critical enterprise infrastructure read from Dell Technologies, DEL.
The growth forecast there is strong. EPS projected up 15.3% year over year.
Right, but the real focus, according to the KMBUF analysis, is going to be on margin resilience.
Why is that?
The report specifically calls out rising costs for memory components like DRAM and NAND. So investors need to hear management explain how they plan to maintain strong profitability amid those cost increases, especially as they look out to fiscal 2027. That call will be a bellwether for the entire hardware supply chain.
And Tuesday is a truly global mix. You've got Alibaba, Baba reporting.
Which gives you deep dive into Chinese consumer activity, often tying back to that Trump-y stability narrative.
We also have Analog Devices, ADI, a key semiconductor supplier.
So Tuesday is just this high-stakes collision of global retail, U.S. consumer sentiment, and industrial component costs. It's a massive day.
And then finally, Wednesday, November 26th, offers the last major data points before the holiday.
Right before everyone checks out.
Deere & Company, DE, which is essential for gauging the health of large-scale capital spending and the agricultural sector globally.
Their expected EPS of $3.84 will give us insight into farmer confidence and machinery demand, which is often seen as a barometer of global economic health outside of pure tech.
And we wrap up the EV and China theme with Li Auto, LI, adding another layer of volatility right before the long weekend.
And remember, the market will be trading on thin volume by Wednesday afternoon.
Which means any unexpected miss from these names could be really exaggerated.
So we've established the Nasdaq Q-sword, but for a rally to be truly healthy, you need broad participation. So if we want to understand the underlying technical health of the market, we have to look deeply at breadth.
How widely was that optimism shared?
Exactly. And what the KING-KAMBUF analysis confirms here is something that's actually pretty rare and incredibly bullish. All 11 major S&P 500 sectors finished in positive territory on Monday.
Wow.
This wasn't a narrow, fragile rally where just 3 megacaps carried the entire load.
That indicates the catalysts, the rate cut hopes, the geopolitical cooling, were powerful enough to lift almost every corner of the market.
It does. This broad-based advance lends significant credibility to the recovery.
However, when we look at the distribution of the gains, that AI and tech concentration theme is still overwhelmingly dominant.
Oh, absolutely. Which introduces a concentration risk we have to talk about.
Technology was the clear leader, up 2.7%. Communication services, which holds giants like Meta and Alphabet, was right behind it, up 2.5%.
And that just heavily reinforces that while the rally was broad, the momentum was driven by capital flooding into the specific stocks that benefit most from AI innovation and, cheaper money.
The contrast here is really crucial.
It is. The defensive sector's energy only managed a modest 0.4% gain, and utilities were up 0.6%. They showed the least enthusiasm.
So if investors were really worried about the economy, money would be rotating into those areas.
Exactly. Into those defensive, high-dividend, less volatile sectors. The fact that the growth sectors outpaced the defensive sectors by a magnitude of 4 or 5 times is the clearest sign that investors were in a risk-on mode.
They were prioritizing aggressive capital appreciation over stability and income.
That's it. And healthcare, despite that Novo Nordisk disaster we discussed, it actually managed to finish strongly at plus 1.6%.
Which is a testament to the strength in other subsectors.
Right? Like medical device manufacturers and other successful biotechs like Eli Lilly, which effectively offset that NVO loss. It just shows that sector analysis always requires that granular subsector detail.
To really understand where the conviction was, the most active list is incredibly revealing.
Yeah, this shows you where the institutions and high-frequency traders were concentrating their capital.
And predictably, NVIDIA, topped the list. 255 million shares traded.
Which is a staggering 33.5% above its average volume.
So that confirms the analyst upgrades and the general AI momentum translated into massive liquid accumulation, high institutional confidence.
It does. But here's a fascinating nuance that points to speculation returning to the market. Ondas Holdings, ONDS.
A smaller, high beta name.
Right. It showed a massive volume surge of 176 million shares, 155% above average. This kind of volume surge in a smaller name, correlating directly with high daily gains, is the hallmark of speculative momentum trading.
So when the VIX drops and fear subsides, traders start looking for those quick, high-percentage moves.
They do. We also saw serious activity in core industrial and EV names. Intel, INPC, traded 104 million shares.
And Tesla, TSLA, 97 million shares, which was 9% above its average volume.
And this just reaffirms that the semiconductor recovery and the EV narrative were absolutely central to Monday's action, alongside the perpetual liquidity offered by the true megacaps like Amazon, Apple, and Meta.
Let's spotlight the extremes here to see who benefited most from the speculative wave and who was facing forced selling.
The real outliers.
On the gainer side, the energy of the rally was just crystal clear. Inspire Medical Systems, INSP, topped the list with a staggering 30.51% gain in a post-trading surge.
And even more indicative of that extreme risk-on environment was the strength in the crypto proxy names.
Right. Bitmine Immersion Tech, BMNR, and Cipher Mining, CIFR.
Both saw gains near 20% and 18%. These stocks are highly leveraged to risk appetite, and their massive gains just confirm that speculative capital has flooded back into the system.
But conversely, the losers list reveals these specific pockets of caution. Arcelex, ACLX, a biotech name,
saw a deep 17% correction, likely related to sector rotation or some specific internal news.
More broadly, we saw names tied to the consumer experience facing pressure. Carnival Corp, CCL, was down nearly 7%.
And Abercrombie & Fitch, ANF, dropping 6% later.
So what does that suggest?
Well, it suggests that while the tech rally was roaring, investors were still exercising some caution in certain travel and retail stocks right ahead of the crucial Black Friday and holiday numbers. It reflects an underlying uncertainty about the real strength of the consumer,
Okay, finally, let's turn to the technical roadmap from KMBUF. For investors and traders, the difference between a sustained rally and a temporary bounce often comes down to holding or breaking these critical support and resistance levels.
These are the lines in the sand for the week.
For the S&P 500, the immediate challenge is breaking that resistance cluster they've pegged at 6,750 to 6,800.
Right. If the market decisively pushes above that, the path back to the all-time record is pretty wide open.
But the critical support level, the floor, is now at 6,650. A failure to hold that would signal the Monday rally lacked conviction.
And that institutions are ready to sell into any strength.
For the Nasdaq Q, which saw the biggest move, the resistance is higher, up at 23,200.
And breaking that psychological and technical barrier is necessary to confirm that the momentum for the growth trade is real and sustained. The key support level to watch there is 22,500.
Yeah, if it dips below that.
If the Nasdaq Q dips below 22,500, you will likely see the high beta tech names facing significant profit taking.
And we have to revisit the VIX watch. We saw that beautiful decline to 16.77.
Right, and the technical analysis emphasizes that the VIX staying below 18 to 19 is essential for signaling that risk appetite is broadening and stabilizing.
But if we see the VIX rapidly spike, breaching that 22 to 24 range,
that is the market's instantaneous alarm bell. A clear signal that fear has returned, likely triggered by a major earnings miss on Tuesday or some unexpected geopolitical headline.
Okay, this next section moves from looking back to looking forward, from analysis to application. The KMBF Daily Report provides highly specific recommendations, and it separates the longer-term investment strategies, what they call spread opportunities, from the high-risk, quick-turn day trades.
Exactly. For investors with a multi-week or multi-month horizon, the top 5 best spread opportunities focus on high-confidence trades with favorable risk-reward.
And they're rooted heavily in the AI, cloud, and semiconductor narratives that dominated Monday.
They are. These are positions designed to capitalize on sustained sector strength. First up, NVIDIA is cited with a spread opportunity of 16.2%.
Okay, what are the levels?
The entry range is $180 to $185, and they're aiming for a target of $210 to $220. The rationale is twofold. Not just the relentless AI momentum, but also the specific technical recovery from the recent lows. The report sees high conviction that NVIDIA will test and maybe even breach its previous 52-week high.
Second on the list is Alphabet GOOGL with a 12.5% spread opportunity.
Right. The entry zone is a bit higher, $265 to $270, targeting $300 to $310. The core rationale here is stability combined with growth.
So it's the safer AI bet.
It's seen as the relatively safer long-term bet on the AI thesis, yeah. It has robust AI leadership and dominant cloud computing strength, but with less overall volatility than a pure semiconductor play.
Third, we have the high beta EV play, Tesla, TSLA, with a 14.8% spread opportunity.
The entry is between $410 and $425, with a pretty aggressive target of $480 to $510.
And the forecast there is based on?
It's based on the technical recovery, the strong volume we saw on Monday, and the anticipation of a wider EV sector recovery, which would be driven by that rate cut narrative. Cheaper money tends to fuel consumer financing, which is crucial for big-ticket items like EVs.
Fourth, and this one offers the highest spread opportunity at 18.7%, is Intel, INTC.
Yeah, with an entry between $34 and $37, the target is set aggressively at $42 to $46, and the rationale is heavily valuation-driven.
It's a value play.
Compared to NVDA, INTC is seen as highly attractive. It's trading far below its previous highs, offering a deep value play that benefits from the broader semiconductor upswing and its own internal turnaround efforts.
And finally, Broadcom, AVGO, is noted as a strong fifth selection.
Right, aligning perfectly with the chip sector rebound. The overarching theme for all these spreads is clear. Institutional money is betting that the AI, chip, and cloud leaders will continue to dominate and that the worst of the recent volatility is behind them.
Which makes any dips excellent accumulation opportunities, in their view. Okay, now we have to dramatically shift gears and talk about the day trading projections. And it is paramount that we reiterate the magazine's explicit warning here.
Please do.
Day trading, especially during a low liquidity holiday week, carries substantial risk and it requires specialized knowledge. We are reviewing the directional biases and methodologies here, not offering you personalized advice.
Right. And the KMBUF framework relies on a specialized internal system. We don't need the acronym, but conceptually, it's a high-frequency volatility model that tracks internal market momentum and volume signatures to generate these very specific buy and sell points.
To illustrate just how precise you need to be, let's look at the NEDA day trade setup from Monday.
Okay, the model identified a crucial pivot point at $185.
What does that mean?
It means if NVDA held at 185 level in the morning, the system projected an intraday range of $180 to $195, targeting a quick move toward that $188 to $195 level.
So it's hair trigger. If the pivot fails, the trade reverses immediately.
Instantly. And you can see the high-conviction BUYs naturally align with the longer-term spreads. NVDA, TSLA, GUOGL, INTC, and Meta are the top directional picks, betting on that high momentum continuing.
But the magazine also flagged high-risk, short-side ideas.
Yes, which demonstrates a crucial trading strategy.
Yeah.
You can exploit specific fundamental company weakness even within a booming market.
The high-risk sell or short recommendations target that perceived fragility in retail and biotech. For instance, the short on Novo Nordisk, NVO, was a classic reactionary trade.
Right, exploiting the negative news of the drug trial miss. The magazine highlighted a short entry near $43, betting on a quick downward move to $42.35 as that volatility played out.
And similarly, Abercrombie & Fitch and Carnival Core were flagged,
due to specific concerns about consumer discretionary spending and early retail weakness ahead of the Black Friday numbers.
So this is a textbook example of directional trading strategy. You're ignoring the bullish S&P headline
and focusing only on exploiting specific, concrete weaknesses. The NVO short was rooted in fundamental failure. The A&F short was based on technical fragility and anticipating poor retail figures. It requires high confidence in the isolated company analysis, regardless of the macro tide. So as we wrap up our deep dive into this daily report, our focus really has to shift to the practical reality of trading this abbreviated week and how this intelligence should inform your portfolio structure.
And the structure of the trading week itself is the single biggest risk factor right now.
Absolutely. We have a holiday-shortened week. The market is completely closed on Thursday for Thanksgiving. Then you get this extremely light volume session on Friday, often called Black Friday trading.
And that structure creates the significant risk of low liquidity. Low liquidity acts like an accelerator on volatility.
It does. If you get unexpected negative news, say a major geopolitical event or a shockingly poor earnings report from Best Buy on Tuesday, the low volume means there are fewer buyers and sellers to cushion the price move,
which can lead to exaggerated price swings that might not reflect fundamental value,
forcing cautious investors to just minimize their exposure on Wednesday and Friday.
And yet, the positive outlook is currently reinforced by multiple factors cited in the KIMBUF report.
Right, trade sentiment is clearly improving, tech is showing renewed, commanding strength, and that VIX contraction suggests risk appetite is robust. The momentum is positive, but the need for vigilance due to the structural risks of the short week can't be overstated.
So let's pivot to capital allocation. The magazine provides structured portfolio recommendations for 3 different investor profiles. We must stress that you should always align this knowledge with your personal risk tolerance and your own financial goals. For the conservative portfolio, the focus is heavily on stability and defensive positioning. The recommendation is 30% in large cap tech, so the safer, cash flow rich names like Apple, Microsoft, and GOGL.
Right.
25% in healthcare, 20% in financials like JPM or Bank of America, and critically, they allocate 15% to utilities for defensive income and 10% to cash.
The moderate portfolio aims for a more balanced growth. It increases the allocation to those high-growth names, including NVDA and TSLA, up to 35% in growth tech.
Healthcare stays significant at 20%.
It does, recognizing its defensive qualities, but also growth potential with names like LLY. The key rotation here is putting 15% into consumer discretionary, targeting resilient giants like Amazon and McDonald's. And cash is reduced to a minimal 5%, signaling more confidence.
And finally, the aggressive portfolio is dedicated entirely to maximizing returns through high-octane growth and momentum.
All in on growth.
It concentrates 40% in growth tech, acknowledging the dominance of NVDA, TSLA, Amazon, and Meta. It pushes the semiconductor exposure even higher to 15%, capitalizing on the INTC and AVGO thesis.
It also dedicates 20% to emerging growth, targeting those high-beta, smaller-cap names that surge when the VIX is low.
And to capture that speculative wave we saw on Monday, 5% is allocated to crypto proxies like MicroStrategy and Marathon Digital.
And regardless of which strategy aligns with your personal risk profile, we have to close with the magazine's essential disclaimer.
Absolutely.
This information is for informational purposes only. It does not constitute investment advice. Market conditions change rapidly, and as we saw with Novo Nordisk, specific news can override macro trends in an instant. Past performance never guarantees future results.
So let's quickly summarize the critical takeaways from this November 24th daily report. The market is overwhelmingly positive, driven by this massive hope of a December Fed pivot and a cooling of U.S.-China trade tensions.
Which resulted in the Nasdaq's best day since May and all 11 sectors closing in the green.
However, the key themes remain concentration risk. The rally is still being driven by NVDA, GOGL, and TSLA, and that ever-present structural risk of low liquidity during this holiday week.
So your immediate focus has to be on Tuesday's critical retail and tech earnings from names like Best Buy and Dell, because they will dictate the momentum for the rest of the week.
Right.
So given the strong rebound in the Nasdaq Q, which was so reliant on the prospect of cheaper money, and the VIX dropping so sharply below 17, we want to leave you with this final provocative thought to track.
Okay.
Is the market's current trajectory fundamentally sustainable, or is the reliant on a December Fed rate cut, which, remember, is not guaranteed, a sign of hope trading? We saw the Nasdaq Q snap back because of expected policy changes. But if the retail and consumer earnings that are rolling in this week fail to show genuine economic strength, will those incredibly high valuations actually hold?
That's the structural tension you need to monitor as we navigate this short, high-stakes week.